this short video, we will discuss hedging risk exposure. We will touch on the topic of risk and how it is initiated, and then follow up with different techniques that can be used to hedge that exposure. We will describe some of the pitfalls toward hedging and when it is practical to mitigate specific types of risks. Generally, when investors consider risk, they are thinking about market risk and how a good or adverse movement will affect their portfolio. Risk can be defined in many ways, but for this video, we will focus on market risk. Market risk can be defined as the chance that an investment's actual return differs from its expected return. Risks include the possibility of losing some or all of the original investment or gaining beyond your initial investment. A basic measurement of risk in a specific market is the standard deviation of the historical returns or average returns on a specific investment. A high standard deviation indicates a high degree of risk, or what is considered volatility. A key component of risk management is risk assessment, which involves the determination of risks surrounding an investment. One of the basic ideas of investing is the relationship between risk and reward. Returns are considered a function of risk in that the greater the risk, the greater the potential reward. The reason for this is that an investor needs to be compensated for taking on additional risk. For example, a certificate of deposit at a bank is considered to be one of the safest investments, and when compared to common equity, provides a lower rate of return. The reason for this is that a corporation is much more likely to go bankrupt, where a common stock could be worthless. Because the risk of investing in a CD is principal protected by the FDIC, the risk of owning a certificate of deposit is very low and therefore pays a relatively low return. Hedging risk. When investors assume risk in an asset class that has a premium above the risk-free rate of return, the investor can consider hedging their exposure when the returns are better than expected and lock in profits. Investors can hedge risk exposure in many ways. An investor could use options on a specific asset or a financial instrument that somewhat mimics the market direction of the asset that is owned. For example, if an investor owned Apple stock and wanted to lock in some of their profits after the stock moved from $500 to $600 a share, they could hedge their risk exposure by either selling a portion of their position or selling another instrument such as the NASDAQ 100. The NASDAQ 100 returns are highly correlated to those of Apple, which would allow the investor protection from downside movements in Apple share price without selling any of the Apple stock that they own. Another type of hedge that an investor could undertake would be to use options to mitigate the market risk. For example, a put option provides downward protection against long stock positions. Buying Apple puts would mitigate some of the downside risks, as investors own the right but not the obligation to sell Apple stock at a specific price. The market risk of a put is limited to the delta of the actual underlying put. Another way to hedge downside risk using option would be to sell a call option. In this case, the investor would receive a premium which would protect a portion of the downside move. As an example, a covered call hedging would be as follows. An investor would sell potentially an at-the-money Apple call where the stock expires in 60 days and would pay an investor $35. Let's assume the current price of Apple is $605 a share. The investor would be protected down to $570, which would be the premium that was received minus the current price. Any movement below 570, the investor would not be protected. If the market in turn moved higher, the investor's shares would be called away, but the investor would continue to keep the premium, making the overall take profit on Apple $6.40. When an investor hedges a position as opposed to taking profit or stopping out of a position, they are increasing their basis risk while mitigating their market risk. If an investor decides that he would like to mitigate the risk of an adverse downside movement by selling an instrument that is similar, such as the NASDAQ 100 Trust QQQs against a long position in Apple stock, the investor has offset the directional risk of Apple, but has taken on a basis risk between Apple and the NASDAQ. Although the likelihood of a basis movement is rare, investors should be aware that this type of spread could move against them. When trading options as a hedge, an investor needs to be aware of the risks associated with options. Protective puts are excellent tools, but they have components which determine a large majority of the cost of the option, which is called implied volatility. When markets are already volatile, the cost of protection can be prohibitive. When volatility is high, selling covered calls is a sound strategy, but will only protect an investor to the extent of the premium that is received, which might not cover a large drop in the price of the underlying stock. Hedging exposure is an important concept in portfolio management, and investors should be aware of all the tools available when trying to mitigate portfolio risk.